Good evening to everybody from sunny Athens. It's with great pleasure to organize a new academic debate on a very interesting topic, with genuine experts on this field. This 16th academic debate is being co-organized for the first time with the Center for Financial Market Regulation at the University of Zurich, which is led by Prof. Our dear colleague, who unfortunately, because of a conflicting other academic obligation at the same time, could not join us, so he will not be with us. But our topic is very interesting. It's on the perspectives on the Silicon Valley bank failure. And I have the great pleasure, welcome and thank Greg Feldberg from the Yale School of Management and Jonathan Rose from the Federal Reserve Bank of Chicago, and at the same time an economist and at the same time a historian of the Federal Reserve System, to discuss this and make their presentations. And then we'll open the discussion. Georg Ringe, Bart Jossen, and Edgar Loeb, members of our academic board at the EBI, and their friends are here with us to pose the first questions. But please don't hesitate to pose your questions on the system, and then I will take care of that in order to complete our discussion within 90 minutes. So thank you very much again. Greg, you have the floor.
Great. Well, thank you, Christos, and everybody for inviting us. I'm really thrilled by the opportunity. Next time, if you hold this in Europe, I'd be glad to jump on a plane and get over there and meet everybody in person. I guess Jonathan and I were a little surprised to see this framed as a debate, since we mostly agree on everything, but it'll be fun if we can tease out some disagreement for the performance at least. So this presentation, let me see. Just really briefly, I was at the Federal Reserve Board with Jonathan actually for a while. I was mostly in banking supervision, but I was also in financial stability. After the Fed, I worked at the Financial Crisis Inquiry Commission, which was the official group created by Congress to investigate the causes of the financial crisis. I was at the Office of Financial Research, which is a new group affiliated with the Treasury Department and the Financial Stability Oversight Council, which tries to fix the data and research for the system as a whole. And then I was a research director at the Yale Program on Financial Stability, where I kind of moonlighted as a economic historian. We published more than 300 case studies on financial crises and wrote quite a bit of analysis when I was there. And I'm still teaching a course on macroprudential policy at the Yale School of Management. So that's probably enough on me. I still have the slide about what we do. Maybe I should skip over it pretty fast, but the program on financial stability at Yale, we've got this research project, which we kind of declared victory on last year after publishing 300 case studies. We have a master's program, most for employees at central banks and other financial regulators. And we also have a journal where we publish stuff on this. So let me move on. So today's paper, really it was built together.
Greg, I'm sorry to interrupt. Is it just me, or I don't see the slides?
Oh.
Nobody sees the slides.
No, we don't see them.
Okay, well, there hasn't been much information lost yet. Let's see. Share. Do you want to share?
It worked before when we tested it.
Yeah, no, I guess I forgot that it wasn't going to be on anymore. Let's see. So, okay. I assume that worked?
Yes.
Okay.
Now it works.
Yes.
Okay, well, here's the slides that go with the words. So today's paper is really, when SVB failed, my colleagues and I published a series of blogs, and we built it up into a more formal paper for the Journal of Financial Crises, which is the journal at the Yale School of Management that we publish. And really, the question that I wanted to look at was how U.S. bank regulation failed the company and its supervisors. And the question, what we did with this was to ask the, because a lot of the debate at the time was, did deregulation matter? Did it matter that SVB was subject to certain rules and not other rules? So we thought the thought experiment would be to say, well, what if some of these rules that you're talking about had applied to Silicon Valley? Let's throw its balance sheet and its and all of its financials into the against those rules and see whether some meaningful action might have been taken in advance. Just to kind of recap the story of Silicon Valley Bank, this was Jonathan's going to call this the standard account. The standard account was that there was a handful of companies which had a significant exposure to uninsured deposits, which were not insured by the FDIC and therefore subject to loans, and also had balance sheets that had a significant amount of mark-to-market losses on their balance sheet. And what the chart shows is that Silicon Valley was an outlier in both categories. Really, the red are other banks by size, which also had similar exposures. But the point was that weekend when Silicon Valley Bank failed, the response was to the news about Silicon Valley Bank and its potential, mark-to-market insolvency. And the concern at the Fed and the other regulators was what other banks are out there with these similar exposures and what can we do to address that. So just to really recap quickly what happened, this was really the biggest, fastest bank run ever on Silicon Valley Bank. It was closed on a Friday morning, which is very unusual. The FDIC saved the uninsured depositors. The Fed came in and did something extraordinary, which was to lend against treasuries at par, taking the interest rate risk essentially off of bank balance sheets. So they saw that this vulnerability that Silicon Valley Bank was affecting other banks and the market was focusing on it. So they essentially said, if you're a bank and the market's starting to focus on your mark-to-market losses, we're going to go ahead and offer you liquidity against those. So you don't have to have a liquidity concern associated with those underwater assets. And then there were two more large bank failures with somewhat similar issues. The result was billions of dollars in cost to the deposit insurance fund or to special assessments, which was how, since the global financial crisis, we fund failure of significant institutions rather than through the regular fund. So just to show you what that looks like, this is the cost of total assets of failed banks on the left in the global financial crisis versus 2023, and the total cost of the insurance fund, and kind of cheats because it throws in the costs of the special assessment. But you can see that this was quite a significant event, even compared to the global financial crisis. So very quickly, how we got here, the same old lessons, really easy money in the years before, just like the G. We learned about the runnability of private money, like in the global financial crisis. And we have this of regulation and deregulation, supervision and desupervision. So one comment from the time: progress is cumulative in science, but cyclical in finance. We have to learn the same lessons over and over again in the field of finance. So what does the easy money look like? There was a surge of deposits after COVID due to all of the stimulus and support that the Fed was offering the market. It's a huge increase in reserves. And then when the Fed raised interest rates in 2022, there was a rapid decline. So second, runnability of private money. We keep relearning this in every crisis, that private money isn't legal tender. Only public money is truly information sensitive. So in the global financial crisis, it was about repos and money market funds and commercial paper. And this time it was about uninsured deposits, which maybe hadn't been considered in the same category, but which are subject to the same concerns. Oops. Sorry about that. Not sure which slide I'm on. So So when it comes to Silicon Valley Bank's runnability, it had this concentrated deposit base. A lot of or most of its depositors were private equity, venture capital funds or firms funded by those funds. There's a lot of talk about role of technology in the run and the role of social media in the run. I think Jonathan and I are violently in agreement that that's kind of exaggerated. There's been runs before, and I think that the speed of the run probably had more to do with the fact that these folks were all in the same tight community and they communicated with each other. But there was a role of technology in the bank walk. There was a wonderful paper that talked about how in 2022 there was a migration of funds from some companies, and this might have been linked to the easiness of withdrawing funds from through your phone. But not sure that that was a key thing. Let's see. And then same mode 3, the regulatory pendulum. You strengthen after a crisis. You throw a lot of complex rules after a crisis, and then when things calm down, you try to simplify, and maybe you ease some of the concerns that you learned from the global financial crisis start to fade in the back. So in the late 2010s, we had tougher rules, but we weakened them for all but the very largest bank. And, tailoring is going to be a theme here, and of course, everybody I think agrees after the global financial crisis that the largest banks should be subject to tailored, more heightened supervisory standards than smaller banks. But the question really is, where do you draw that line? And in 2018, Congress directed the regulators, and the regulators complied by raising the limits, just the asset value limits and other standards that subjected banks to heightened supervision. So banks of Silicon Valley Bank size ended up continuing not to be subject to some of those standards. We also made it harder for supervisors to impose quantitative standards. There have been various rules that regulators had put in place. I should say guidance that regulators had put in place, which were challenged in court and made it more difficult for supervisors to set specific quantitative rules. We agreed to global standards, but didn't implement it in the U.S. But I'm going to be talking about interest rate risk standards first. And we put out stronger rules, but then changed our mind in a lot of cases in response to opposition from the regulated entities. There was also desupervision in the years before COVID and before the failure of Silicon Valley Bank. The Fed vice chairman put a lot of pressure on supervisors to just be more firm and fair, and even use the word nice to banks. They strengthened the role of the ombudsman. They strengthened the ability of banks to complain, to appeal exam findings, all of which kind of changes the tone of the supervisors, who are always kind of challenged with when it comes to challenging a bank that's making a lot of money and succeeding. And we went easier on banks that were smaller than 250, so 250 billion became the threshold. Meanwhile, when it comes to those two issues of exposures to interest rates and unrealized losses and exposures to uninsured deposits, I'm not sure everybody in Europe is aware how many annual financial stability reports the U.S. puts out. But in addition to the FSOC annual report, the Fed puts out a financial stability report twice a year and a supervision report. The Office of Financial Research is reported to report independently on financial stability, and even the OCC, the bank supervisor, reports twice a year on the risks that it sees. So in 2022, the year before Silicon Valley failed, when the Fed was rapidly raising interest rates, so the question of what the exposures of interest rates could have been should have been a key topic. All of these supervisors' reports, mentioned that interest rates were rising. Most of them mentioned that banks might had some unrealized losses on them. Only one of them actually pointed out that having losses in your held-to-maturity book could result in a liquidity issues, and none of them talked about uninsured deposits. That was what my review of how forward-looking the reports were after the fact. And everything we're doing here is in hindsight analysis, of course. So the thought experiment of the paper was, if certain rules had been applied to Silicon Valley Bank, could they have prevented the management from taking this huge one-way bet that the bank took on interest rates? So what could the management have done to avoid failing? and what could regulators and supervisors have done to force them to avoid failing, to force them to take whatever those steps are that the bank could have taken. So just the quick timeline of what happened with Silicon Valley Bank in 2020 after COVID, huge easing and quantitative easing and easy money in the U.S. Deposits for the bank, like many banks, were easy to get. There was also a venture capital boom in 2021, so their deposits came in as they lent money to their customers. And as these deposits rapidly increased, they essentially put it mostly into residential mortgage-backed securities. So their MBS holdings were up 90%, 250% in 2021, and then in 2022, when the Fed tightened, the venture capital industry tightened, venture capital firms started to draw down on their cash, which was understandable since they had raised it in a venture capital boom. So just over 2022, there's this kind of slow walk of deposits out. The mark-to-market losses started to just mechanically rise on these long-term securities that they purchased, and the net interest income was under pressure. And then, of course, in 2023, in March, they announced that they had sold $21 billion of treasuries, which was essentially all of their treasuries, which were in their available for sale book, and that they planned to raise capital to cover the losses, which panicked the market. The market immediately focused on the losses in the held to maturity book, and there were rapid deposit withdrawals because nobody really bought the idea that they could just raise capital and get just buy their way out of their capital hole. And then the regulators took over the bank during the day on Friday. So I think one of the things that in hindsight again might have been ignored or forgotten is that this was quite a bold story during 2021. This is just one example of what stock analysts were saying about Silicon Valley Bank, just highlighting from 2021. They had the best ever quarter in the first period of 2021. The future remains bright. It's in the innovation economy, so it's got buzzwords. Basically, note on the bottom, even though average interest rates are far lower than they were pre-pandemic, the bank's assets and loans have grown so much that they're still making much more interest income. So part of the buy story was the interest income they were making in the low-rate environment, and not a lot of focus on what the risk would be if interest rates went in the other direction. And then this is the kind of shocking picture of the share price. So that analyst who wrote that in the first half of 2021 was right, as long as the Fed's rates were low, and very wrong when rates turned around. So what this chart shows is Silicon Valley's bad gamble. So the light blue is the growth in securities, and the dark blue is the growth in deposits in billions of dollars. So you can see, going way back to the beginning of COVID, they were getting a quick influx of deposits, and they were putting it basically into securities. The growth in their loan book was insubstantial compared to this, and they kept on doing this until the Fed started to raise rates in 2022, and you see the immediate mechanical correlation in the gray line. The Fed funds rate goes up, and the cumulative losses in their HTM book and their AFS book it just goes all the way to 15 billion by the third quarter of 2022, which really is almost equal to its equity capital. So it was technically virtually insolvent by the third quarter of 2022. And since we're performing something in hindsight and asking the question, well, what could rules have done? What do we want the bank to have done? And when would it have been too late? What this chart suggests is that by the end of 2021, it was really, too late. They already had this massive portfolio in place, and so if you wanted to take action, you'd have to take it by early 2021, if not earlier. And just to kind of emphasize, most of these securities had maturities of more than 10 years, so they were extremely exposed to rising interest rates. Their value would lose quickly when rates rose. So, and that, as you can see, it's mostly held to maturity securities of more than 10 years, and it's mostly mortgage-backed the orange, the held to maturity securities were mostly mortgage backs, and the available for sale were mostly treasuries. So in other words, they really couldn't sell. They couldn't sell anything in this without realizing a substantial loss. So the only liquidity they could get out of this would have been through repoing at deflated values. So, with 100% hindsight, what do we want them to do? We want them to manage their assets and liabilities better. They could have taken the potential risk of losses from rising interest rates seriously. They could have taken a more conservative view of depositors' beta and decay, both of which turned out to be way more cyclical than imagined. They could have declined deposits to avoid risk. And I think this is maybe one of the most interesting aspects of the way they ran their company, that they had, in their investor presentations, they would say they had $300 billion of deposits under management. Half of that was on balance sheet, and half of that was being managed for their clients in money market funds. So, they were consciously keeping half of that on balance sheet. They could have easily just decided they were taking too much on balance sheet risk and told those customers that they were managing, more of that in money market funds, or all of it, to avoid the interest rate risk. Of course, that would have lowered the profit, but it would have been the easiest way to manage their risk safely. They could have just bought shorter term securities rather than longer term. They could have raised capital to absorb losses on available for sale securities much earlier than they did, not in March, when they were already technically insolvent. So these are the actions we want regulation to make them take. So let's figure out whether some of those regulations could have done it. So just looking at the official reports that came out on Silicon Valley Bank, they tended to focus on the supervisory approach, the transition of Silicon Valley from regional to the large bank portfolio, which basically meant that they kind of they dropped the ball in the transition from one bunch of supervisors to another bunch. As a result, the supervisors didn't identify vulnerabilities, or did identify, but didn't act to ensure that the bank fixed them. And a key that they point out is that the regulatory tailoring had promoted a less assertive supervisory approach. So one way or another, they didn't crack down, and even on issues that they did identify. So what seemed to me missing in those official reports was also focused on the regulations, which is where our analysis came in. The main tools that we looked at were interest rate risk in the banking book and the liquidity coverage ratio. Our conclusions were that examiners are typically at a disadvantage when challenging management of a profitable bank about risks that may or may not transpire far in the future. And then this is the quote in dark italics that I hope everybody will take away from our paper and our presentation, that strong rules can both empower competent supervisors and act as a floor on supervisory incompetence. So whether you believe that the supervisors of Silicon Valley Bank were just hopelessly clueless and had no idea about interest rate risks, or that they were aware of it and were too afraid or unable to challenge the management, a rule would have required that way. So when it comes to interest rate risk management, just really quickly, Basel set the standard for interest rate risk management in 2004. A bit of history about that is that the standard for interest rate risk management really came out of the U.S., came out of the Fed, and goes all the way back to the savings and loan crisis in the U.S., after which Congress told the U.S. regulators to come up with some kind of interest rate risk standard. And the U.S. regulators proposed one, didn't implement it, then Basel went ahead and did implement it, but then the U.S. never bought into it. So this is a fascinating story of political economy. And then after the global financial crisis, Basel Committee again strengthened the standard, just noting that interest rates were at historical lows and would eventually rise, and it was important for supervisors to focus on this. And again, the U.S. didn't adopt the rule. So as it currently stands, the Basel standard in interest rate risk management requires that banks follow a standard economic value of equity measure, that they shock that economic value of equity with 6 interest rate shocks, that there be a threshold, which is currently set at 15% of capital, to identify outliers, so the banks that are outliers against the rule, some kind of capital charge or other measure to address a gap, and then public disclosure of interest rate risk sensitivity. So those are the key 5 elements of the Basel rule. So again, the US didn't implement it. The SEC does require sensitivity reporting. The OCC guidance has recommended an outlier test as an aspect of an examination, but they said they only apply to that to banks with more than 700 billion in assets, and there's no particular obvious repercussions from it. The Fed guidance is even more limited from the exam manual. The goal of interest rate risk management is to maintain a institution's interest rate risk exposure within self-imposed parameters, which is almost like telling you we're gonna monitor speeding on the highway, but you can set your own speed limit. So it turns out the Silicon Valley its economic value of equity deficit would have exceeded the Basel rules for 4 out of the previous 5 years, and the decline would have been 30% versus the threshold of 15, which would have resulted in a $3 billion capital raise in 2021. So this is kind of the money quote of our analysis, which is clearly if they'd been subject to this rule, there would have been an automatic hole that would have been identified, whether it was addressed through capital raise or through some other way. And it really was an outlier. 75% of banks had deficits much smaller than that. To show what that looked like, the red dotted line is the Basel limit, the blue is their reported. So Silicon Valley Bank remarkably reported quarterly their exposure to interest rate risk for years before, which I haven't found another bank that was as diligent in reporting this, even though they didn't manage to it. What it showed was that just a parallel 200 basis point shock increase, which is the blue line, they would have fallen below the threshold as early as September 2020, which would have been way early enough to address the way that their balance sheet was going. At that time, the balance sheet was still significantly under $100 billion and nowhere near what it ultimately became. This is a similar chart, but it shows what the bank's reported exposure was against its own internal limits. So even by its own internal limits, it was already out of compliance in September 2020, something which the Barr report did mention. So what this metric suggests is that this metric was pointing to trouble before they even started to build up their deposits and started to build up their exposures to long-term interest rates. And I guess I should go a little faster. Might be eating into Jonathan's time. So what this chart shows is that the OCC actually had an biannual survey that compares banks in percentiles of their exposures to interest rate risk. So this essentially shows that the dark gray line versus the dotted gray line, Silicon Valley its exposure was already worse than the worst bank in that survey. And the OCC survey is a little weird because it's a different bunch of banks every survey, and it's not clear which banks that they're including. But in every quarter from September 2020, except barely in the fourth quarter, that was significantly below the worst bank in that survey. So I really feel like I'm eating into Jonathan's time, so let me try to go quickly here. So the short answer is that a rule with specific quantitative thresholds might have helped. Regulators have been discussing a capital charge. Is probably not going to happen in the U.S. There's other ways that you could go about doing this, but at the very least, you would like to see the U.S. Impose the IRRBB standard from Basel, which they haven't imposed yet. The other thing we talked about was the liquidity coverage ratio, which, as everybody knows, is a Basel standard for high quality liquid assets to meet 30-day net outflows based on a stress scenario. Silicon Valley banks, I guess, very similarly, it was long out of compliance with that as well. And it was difficult to calculate a liquidity coverage ratio from the company's public reports because it isn't subject to the same reporting requirements as the largest banks in the U.S. But the Barr report did provide their calculation, the Fed's calculation for the previous five quarters, I guess. And so what we did is we put together a model that tried to get right the numbers the way the Barr report had. And so the blue numbers essentially were reported, the light blue numbers were reported by the Fed in the Barr report. The dark blue numbers were the closest we could get our model to that. And just based on that, we found that its shortfalls of HQLA were 6 months before, they were close to $20 billion. If you assume 100%, but you should really assume more than 100% LCR because banks that are subject to it tend to have a buffer over that. So if you assume 125%, they really would have required HQLA to be $20 billion more a year before they failed, which would have been a significant difference in how they manage their liquidity risk. So, the short answer is if they'd been subject to the liquidity coverage ratio, they would have held substantially more HQLA, mostly treasuries. Most of what they held was mortgage-backed securities, which are limited in the LCR. So if they wanted to meet a LCR standard, it would have had to be more treasuries. They didn't really have a whole lot of treasuries, so that would have been a significant difference. The losses that they experienced were much more severe on the mortgage-backed securities than the treasury. The Barr report also pointed out that the LCR rule also requires banks to manage their risk better and be more transparent with supervisors about their liquid assets. So there would have been supervisory benefits to this as well. But again, still just like the interest rate risk, there's been little discussion in the US about applying the liquidity coverage ratio to more banks since the crisis. There's a lot of ways of looking at LCR reform. I think the easiest lesson here is that it should be applied to all banks in the US like it is in other countries. There was some talk about whether outflow assumptions needed to be raised on uninsured wholesale deposits. I'm really not sure that one case makes it necessary to change the rule, but I think maybe just making sure the rule is applied as it is it would be a good enough reform. But there's other things that could be done if you wanted to make it more palatable to prevent this kind of risk from building at banks. We also looked at the total loss absorbing capacity. I should really just go through this pretty fast and go to the conclusion. What we found was that if the Silicon Valley and the other failed banks had been subject to the TLAC rule, then it could have saved the Deposit Insurance Corporation $13 billion because they would have been required to hold more debt that would have been bail-inable. So I should probably leave it at that and let Jonathan go.
Okay.
Thank you much, Greg.
Let me just say that sorry, Christos, go ahead.
Yeah, I will give you immediately the floor. I understand there has been a mix of regulatory and supervisory failures at the same time. We may wish to develop on that. We have a lot of questions on the chat. One point that you raised, and I want to discuss with you later, is this statement by the Fed Vice Chair that supervisor should be firm but fair. Why not firm and fair? What is the distinction in this case? It was part of your de-supervision discussion, but one at a time. Jonathan, you have the floor.
Okay.
Thank you.
Thank you. And I'll just acknowledge that I saw a number of questions in the chat, and I think I can get to a couple of them in the course of my talk, but I think we have plenty of time after I'm done to talk about everything. So thank you for inviting me, and I'm going to take a slightly different approach, I guess, to Greg, although we don't really fundamentally disagree with each other. This paper was written with Steve Kelly, who was a colleague of Greg's at Yale. Now he's at the Federal Deposit Insurance Corporation, although I will say that he was not there when we wrote this. But nevertheless, let me just give the disclaimer just to make sure that the opinions here are just ours. They don't reflect anyone else associated with our institutions, the Federal Reserve System or the FDIC. So the title is Rush into Judgment in the Banking Crisis of 2023. There is a double meaning to this title in the sense that, in crises, depositors rush to judgment about their banks, and we certainly saw that in 2023. But we also think there was a certain amount of rush into judgment about the causes of the crisis. And I don't necessarily mean that in a pejorative way. What I mean is that there was a need for information and analysis as rapidly as possible, and which is natural during a crisis from both depositors and on the regulatory side. Now we have the benefit of hindsight, and I think we think that we can revise some of the views that were created in a rush during that month in 2023, and the basics of it are, let's see. Great. Let me go through what we call the standard view on the left, which is first that there is a focus on Silicon Valley Bank, and I don't mean to caricature Greg at all because to be honest, we were responding to broad literature that has really focused on Silicon Valley Bank almost exclusively. And so there are many examples of this. But so the standard view generally just thinks about Silicon Valley Bank and analyzes it in detail. And second, basically, it describes the cause of failure as a combination of unrealized losses on securities after interest rates rose and uninsured deposits. And then third, these runs were very fast, historically probably the fastest we have on record. And the standard view ascribes this to the advent of social media and digital banking, which allowed for coordination and made deposits withdrawals faster. So that's the standard view. And that developed pretty quickly in March 2023. And here's where we have some differing views. The first is that, the problem we have with this focus on Silicon Valley Bank is that there were some other banks that failed. And the odd thing is that the other banks that failed have a lot similar with each other, but not with Silicon Valley Bank. And that to us changes the way we think about the crisis, especially that Silvergate Bank, which I'll talk about in detail in a second. It was the first bank to fail, and it had a very different business model than Silicon Valley banks, and we think it leads to a different interpretation of what set off this. Now, in terms of unrealized losses and deposits, the combination of them. Well, and here is one of the questions that Jakub asked. I think it was his first or second one in the chat, which is that there are hundreds of banks in the United States that have that had and still have elevated levels of unrealized losses, and of course, everybody has uninsured deposits. So it's just not clear to us why, in the end, based on if this is truly the cause of these failures, why only in the end about 4 banks failed, depending on how you count. Instead, our view of the crisis is that the banks that failed because their business models were scrutinized, and there were a couple of business models that really withered under that scrutiny. One was focused on venture capital in the case of Silicon Valley Bank, and another was focused on crypto asset customers in the case of Silvergate Bank and its Signature, which I'll talk about in a second. And that unrealized losses and uninsured deposits are inadequate explanations in the sense that they cast too wide a net. Okay, and then finally on social media and digital banking. Well, the issue here is that social media is a retail phenomenon, but it's hard for us to believe that institutional depositors are taking their cues from social media. They have much better sources of information. And digital banking, well, we've had wire transfers, ability to make same-day transfers for a very long time, and so it is hard to account. These runs were like a week faster than any other comparable run you can find, and it is hard technologically to explain it. And instead, we view the runs as fast because it reflects the unusual nature of the depositor base at these banks, rather than changes in social media or digital banking. So let me get into the details now. I've said that Silvergate Bank was the first bank to fail. Well, here are the list. Silvergate Bank failed on March 8th, followed by Silicon Valley Bank on the 10th, and Signature Bank over the weekend. March 12th was a Sunday, and First Republic Bank a couple months later. Now, Silvergate Bank often gets left out of these discussions, in some cases, often because of a technicality that you can see that it voluntarily liquidated as opposed to being seized by a government regulator. Now, this is an interesting thing. It used to be in the U.S. a long time ago that voluntary liquidation was pretty common. Nowadays, it's not common at all. So technically, in some technical sense, Silvergate didn't fail because it closed itself. However, if you read about what was going on in Silvergate, up to this point, its business model, it was basically no longer operating at this point. It has shut down its main business lines, and let's talk about what happened at Silvergate Bank. Silvergate Bank served crypto asset customers. It offered them a payment network so they could pay each other within the bank. And it lost 50% of its deposits after FTX failed in November 2022. So this was a gut punch. This bank was cut in half, over the course of a week. As a result, by March 4th, 2023, this is about a week before this crisis, it shut down Silvergate Exchange Network, which was this network that served crypto asset customers at the bank. And right around this time, it experienced a second deposit run, which is probably related, although I don't have this information, to the shutdown of Silvergate Exchange Network. Then on March 8th, Silvergate announced that it was voluntarily liquidating. So you'll notice that so far I've not talked about Silicon Valley Bank at all. But there's clearly something going on in the banking system at this point. Now, this is an unfortunate coincidence of timing in many respects, because on March 8th at 4:06 p.m. Eastern Time, Silicon Valley Bank announced that it was having it needed to raise capital. Was the main thing it was announcing, that it was selling its available for sale security portfolio, and that it needed to raise capital, but it had not been able to yet, which was very important. I think they would have preferred to have announced that they had been able to raise capital, but they couldn't. And then 24 minutes later, Silvergate announced that it was voluntarily liquidating. And these two events certainly affected each other. Silicon Valley Bank's CEO talked about in congressional testimony how the liquidation of Silvergate within the same half hour led to negative investor sentiment that made this announcement to be taken even worse than it might have been taken otherwise. So this leads us to a view of the crisis that we start the crisis really with the failure of FTX in November 2022, and this is pretty different than most accounts of the crisis. Somewhat odd, because Silicon Valley Bank really didn't have much connection itself. But what the SVB, what the Silvergate, what starting the crisis with Silvergate does is it helps us think about the business models that these banks were running. So what Silvergate was doing was, it had this thing called Silvergate Exchange Network, which you can see on the right here. And these are the names of so many of the crypto asset customers it served. This was a screenshot from its website from a few years ago. And they were trading crypto among each other, but they needed to settle in national currency. And because crypto settles fairly instantly, they needed a settlement leg in national currency that was at the same speed, and they could only do that by bookkeeping accounting inside of a bank. And so that's what Silvergate Exchange Network was offering them. And the other bank that the third bank to fail, Signature offered a similar service. It was the only competitor to Silvergate Exchange Network. It was Signature's own settlement service. So basically, these two banks were in the same field of offering payment and settlement services to crypto asset customers. And this helps explain why Signature, of all the banks in the United States, Signature was the third bank to fail, because it was directly connected to Silvergate. It really had no connection to Silicon Valley Bank, but it had this clear connection to Silvergate. And so this is why sometimes it's a bit odd that there's so much focus on Silicon Valley Bank, because the first and the third banks were very connected to each other. The business model of Silicon Valley Bank, meanwhile, was much more centered on venture capital. And Greg already talked about this to greater detail, and it's more well known, so I don't need to talk about it. But there were some other banks that had similar focuses, including First Republic, which did end up failing a month and a half later, and a couple other banks, PacWest and Western Alliance, that came under a lot of pressure, but did not end up actually failing themselves. So I'll get back to this. This will become a theme throughout the rest of the next 15 minutes or so, but or maybe it's 10 minutes. We tend to view a lot of this now through the lens of the business model. Let's talk about unrealized losses on uninsured deposits. The issue with this is the following. Now, this graph is somewhat similar to what Greg showed before. I'm scaling the vertical axis by assets, I think, whereas he was doing it by just securities, I think. But anyway, it's basically the same data. And you can see the four banks that failed, there's certainly outliers on the percent of deposits that are uninsured. You'll see that Silicon Valley Bank and Silvergate Bank are somewhat outliers on the unrealized losses side. But our issue here is this is kind of like, if you run a regression, yes, you can get that these banks pop out of that regression with these two variables. That is correct. It is kind of an ex post data mining exercise, in the sense that on an economic basis, it is not clear to me that economically it is radically different to have 90% uninsured deposits versus 50 or 60% in the sense of their ability to impose market discipline. And similarly, there are hundreds of banks that have unrealized losses. And so if in practice, many banks have failed over history with 50% of their deposits uninsured, and those depositors withdrew their deposits. And if that is an economic mechanism that can happen, why are there so many of these blue dots with unrealized losses, but more moderate levels of uninsured deposits, but they did not fail? So putting that a little bit more on point. Here's some other examples of banks. So now for an American audience, these names ring a bell. I don't know if they will ring a bell with you, but two of the biggest banks that failed in 2008 were Washington Mutual and Wachovia. And each one of these had, oh shoot. So when I go full screen, I can't see my notes. Maybe if hopefully this is still working now, I can see my notes. And Washington Mutual had 26% uninsured deposits, and Wachovia had 39% uninsured deposits. And they both had terrible deposit runs in September 2008 and ended up failing as a result. And so, just empirically, even at the very largest banks, it is not necessary to have 90% of your deposits uninsured. Certainly Silicon Valley Bank and Silvergate and Signature, they stand out on that basis, but that's in an empirical sense, you can make them pop out of regression that way. But on an economic basis, our whole system of deposit insurance has depended on the idea that partial insurance will ensure market discipline. And we should actually be very worried if the conclusion from the crisis is that only banks with 90% uninsured deposits face market discipline, because then that means there's basically no market discipline left in the system at all. Continental Illinois, which is actually was right across the street from me here in Chicago back in 1984, it had similar levels of uninsurance. It was 85% uninsured, if I recall correctly. So I'm going to come back to Continental because I think I view it as one of the better analogs for thinking about the problems here. Okay, let's talk about technology. Okay, so as I said, a view of this crisis has been that technology made the bank runs worse. Let me give you some quotes along these lines, starting, I'll do this clockwise. Electronic communications make it possible for institutions to raise or lose funds practically instantaneously. The problem was a lightning fast removal of large deposits from around the world by electronic transfer. Today, through an electronic button, you can empty out deposits overnight. It's different. And finally, runs are caused more often by an electronic phenomenon, the ability to withdraw money electronically. So this is the punchline of this slide, is that I've been playing a trick on you, that these are all about Continental Illinois in 1984. And the last quote gives it away, because what it says is, in the wire room, the employees knew what was happening. As withdrawal order after order moved on the wire, bleeding Continental to death. Some cried. So all these quotes were written in 1984 by regulators or by people in industry or in the news media talking about Continental. And what happened at Continental was it had a lot of large institutional customers, and they all withdrew via the wire. And actually, for those of you on the other side of the Atlantic, Continental, I believe, had an office in Belgium, and it raised a lot of money on the Eurodollar market. So it actually invested a lot in its the ability of its depositors to access their funds electronically because of that setup. Here in Chicago, at the time, we had a very restricted banking law. Continental could only have one building, and so it was very active in these large-scale funding markets. So the thing about wire transfers are that they go back a long time. The Fed established a wire transfer system pretty much after it was created in 1913, and this has been actually one of the Fed's greatest contributions to the American payment system. And that wire system has featured very prominently in runs in the 1930s, in 1984 in the case of Continental, and in 2008 and 2023, because it's the fastest way to get funds out. And focus on wires because large depositors use wires, the wire system. They control an outsized portion of deposits. They're uninsured. They're more informed. They act faster, and they've always used the best technology. It's kind of funny because at least in the U.S., we have all these pictures from the Great Depression, like on the right, of depositors amassing either inside or outside banks. And this is our image of deposit runs. And it's a very natural one. But the issue is that if you're a large depositor, if you have $300 million in a bank or a few $1 billion in a bank, which is what the largest Silicon Valley Bank depositors had, there's no way you can withdraw this in person. And also, why would you stand in line when you have other ways to withdraw it through the wire system? So, it is very difficult to understand how, compared to Continental, which had a similar level of low insurance and extreme dependence on the wire system, that Continental's run took 9 or 10 days, and Silicon Valley Bank's run took essentially 1 day. And they were both all on the wire system. So it's just based on a speed of withdrawal. I can't make that math work. You can speed things up maybe by a day or two if you think it's, there's some fewer frictions and more people have access. Now, maybe there's a hot money argument that Silicon Valley Bank and other banks can reach depositors who are more likely to withdraw if they know that they can withdraw easily. I like that version of the argument a little bit better, but I still have a little bit of trouble with it. All right, so let me finish up with some policy conclusions in 2 batches. On liquidity practices and withdrawal assumptions, well, there's been discussion about whether or not we should increase withdrawal assumptions across the board for liquidity coverage ratio purposes or whatever, that we should just view all depositors as more likely to withdraw large amounts immediately because of technology, because of social media. And we're pretty skeptical of this argument, especially across the board, because at least on a technological basis, the argument I just made, it's hard to understand why there should be a permanent difference. We do, however, one of the things that came out, especially at Silicon Valley Bank and First Republic, are high net worth depositors. And in this episode, they're retail customers, but they acted a lot more like institutional investors, and they withdrew a lot faster. And this historically is a little bit new to me. I can't remember such depositors having such high salience in previous episodes. And if liquidity assumptions, maybe liquidity assumptions should take into account that these depositors are closer to institutional depositors. But our bottom line for liquidity practices is that we think that the assumptions about withdrawals should focus on the business models. In the case of these banks, what we saw is a lot of concentration in 1 or 2 industries and a lot of interconnectedness among depositors. So for example, at Silvergate, I mentioned this deposit network. Well, this payment network. This immediately tells all the depositors whether another depositor has left the bank because they can't use the payment network to pay each other. So there's this real-time system of knowing whether other depositors have left, which is pretty unique in the annals of deposit runs. The thing about this business model argument is that I view these business models, these niche business models, as likely to become more and more common. We used to have 20 or 30,000 banks in the United States. But around the Depression, even 30 years ago, it was like 15,000 banks. Now we're down to just a few thousand. But the trend now is that because we've had the emergence of large national banks that operate all across the U.S., new entrants don't try to compete at a national level with the large banks on a full set of services for all customers. Instead, many of them are trying to find a specialty. A niche like venture capital or like crypto, or there are a number of other niches that have developed that are not associated with this crisis, like fintech customers or customers in certain economic sectors. There are banks that serve real estate companies for the purpose of mortgage settlement, or that target certain types of corporate lending. And so this creates deposit concentration, it creates interconnectedness. And so this problem strikes us as likely to just become broader and broader as new specialty banks develop. So all of this, we think, has important implications for supervision. In terms of monitoring social media, there's been discussion of this, but and it could be useful to monitor social media. I just think it's important to know what you're monitoring. If you want to know what retail customers are up to, it's great. But I would be worried about thinking that we can monitor large institutional investors through social media. In terms of monitoring balance sheet variables, you know, what this analysis suggests, and I've heard this stated many times, is that supervisors missed something that was obvious, that you can read it right off the call report, that these banks had unrealized losses, they had uninsured deposits, it was very easy to catch. And I agree, that is very easy to catch. And I'm not sure that it wasn't caught. What the issue, I think, is, as we noted, there are hundreds of banks with unrealized losses. And so the issue was narrowing down which ones were actually at risk. And so that's why we focus on business models. It's not that some business models should not be allowed. It's at all. That's not the point. It's the use of business models to interpret balance sheet variables. I mean, there are some custody banks that have large amounts of uninsured deposits, but that's a much safer way to take uninsured deposits than in outside of a custody setting. So that's a very simple example, but it demonstrates that the business model radically changes the way you think about about balance sheet variables. And then finally, monitoring specialty banks with niche concentrated business models, I think will be an interesting challenge to see how bank regulators deal with it. It's an awkward subject because regulators do not want to tell and should not be telling banks what their business model should be. There's a pretty strong line there, and that's not what we're proposing. The issue is, again, it's how do we interpret the data about your bank from balance sheets or from other sources, and using the business model to understand the risks that those data are telling us. All right, I think that's the end of my remarks. And what's next? You're on mute, Christos. Sorry.
Christos, you are still mute.
You're mute.
Yeah. Reading my lips, I thanked you for your presentation. There was a lot that can be discussed on your points, but I will now firstly give the floor to my colleagues. Georg, you raised your hand, so you are first. Then I see Edgar, and then Bart. We have some 10 questions from the audience, and then I will go with my questions if we have time. Georg, go on.
Thank you so much, Greg and Jonathan. That was super interesting. I have two quick questions because there's so much in the queue. I just want to be very brief. So one is to both of you, essentially asking, what's the political story here in the background? Because if I remember that story myself, and it seemed to come out of your talks as well, that Silicon Valley Bank was not a big player, right? It was not a big systemically important player, the sort of bank that we're used to from the 2008 crisis, but it was comparatively small, so it wasn't really systemic. And then why, what's the ultimate political motivation then for creating that fuss? And was it that, as one sometimes hears, that they were quite well connected politically or quite relevant as a player in a particular niche area? That sort of is that might be a plausible argument. And if I may, just a quick second point that goes a bit more to what you said, Jonathan, about the technology. I found it really quite fascinating to listen to that. And this was already 2021, right? And just imagine where the technology stands today. If that continues, then bank runs will be ever more powerful, ever more faster. So my question is, every technological problem usually also has a technological response or solution to it. So I was just wondering, is there any technological response that we can think of? Anything that might be equivalent to I don't know, implementing some sort of capital control or limiting access or something like that to address the problem. That's my question. Thank you.
Great. Okay, real fast on the systemic importance. I think by that weekend, when Signature failed, the third bank on a Sunday, there were reports of runs at maybe a couple dozen more regional banks in the U.S. There's a great paper by some folks at the New York Fed, including Cipriani is the first author, where they use FedWire data to count up the number of banks, and I think it was 23, as I recall. And so I think there was a fear that it was spreading, and from there, and that's where the Bank Term Funding Program came in. Yeah, I mean, I'm going to stay away from the politics. It's fair to say, though, that Silicon Valley Bank had not reached systemic status, but it had grown really quickly, and all of a sudden was a lot larger than it had been. But there was a contagion mechanism happening that was somewhat surprising. Anything to add there, Greg?
I mean, I strongly agree. I mean, I'm not sure that in some countries a $200 billion bank wouldn't be considered small, but I can also see that it wouldn't be a GSIB. But maybe there ought to have been a category like other countries have for DSIB. But yeah, I mean, ex ante, this wasn't acknowledged as a systemic bank. It clearly became a systemic bank over the weekend for the contagion reasons. And I think, I mean, that kind of gets to, I guess, since I'm here representing what Jonathan called the standard argument, which was, or the standard account, which was that it was, first and foremost about that toxic combination of uninsured deposits and mark-to-market losses, which was that we never really got to test the theory of how the market would respond to all those other banks that had both of those aspects, because the Fed and the FDIC did over the weekend to address them. And so quite reasonably, Jonathan makes a great case that the banks that were left, once you take an interest rate risk off the table, and once you provided liquidity on those underwater assets, the banks that were left to worry about were certainly the ones that Jonathan talks about. It hadn't intervened, and the FDIC hadn't intervened that weekend, and we might have seen a much broader run. And that was what the Fed was worried about, was the run on the banks that had that toxic combination.
Yeah. Well, yeah, I will say that, the Fed took interest rate risk off the book for, treasuries and agency securities, though there was still a lot of interest rate risk in the loan books, right? So depending on, you could make an argument, though, that the Fed's action instilled a lot of confidence in the market regardless. On your technology question, Georg, that's a tough one. It's come up a lot also in the context, for example, of the rollout of real-time payments. And I probably don't have much more profound thoughts relative to that. But people have talked about automatic tripwires. But the interesting thing is it intersects with this growing question about stable coins or narrow banks and inflows into those, because currently the way like FedWire is set up is that they check to see whether or not there are enough funds to make the payment going out, but there's nothing to stop a payment going in. And so why would you have a payment system set up for that? You just check whether or not people have the funds,
It's the reason for these. It's the reason for these holding limits, right? In central bank digital currency, which are because they might be too safe, right? People moving money too fast.
Yeah, so there's this. This is why I think master accounts have become such a hot topic in the U.S. in part because there's this demand to have the safest form of central bank money, and having a master account allows you to provide that to your customers. So all I can say is the master account issue is being actively litigated, and so I can't talk about it.
Georg, if I may, before I give the floor to Edgar, as a matter of fact, what you raised in your first question, the fact that Silicon Valley and the others were not really systemically important, was the reason that the administration decided to exempt them from the liquidity coverage ratio, correct? So there is a vicious circle here, and if I understand correctly, a lesson to learn, also in the context of our simplification, deregulation, whatever discussion in Europe, is that even less systemically important banks can cause a situation like the one that was created at that time. Yeah.
Absolutely, because I mean, regulation always comes ex post, right? After 2008, we just thought about systemically important banks, and now we realize actually it can also be smaller banks that are problematic. So,
and if I remember correctly, the first paper that you published, Greg, immediately after the crisis was that, if I understand it correctly, I think we have talked about that together, that if the Silicon Valley Bank would have been subject to the liquidity coverage ratio, the probability is high that it would not have ended up in the situation it ended. Yeah, so a kind of hypothetical scenario, but still very strong. Okay, let me not take the time from my colleagues. Edgar.
Thank you so much. And I'm referring first to Jonathan. What you said is, I think this is quite important to remember. The business model of the bank. The business model was concentrated on, right from the start, when they were founded in the 80s, they had the aim to concentrate on startups. So when you concentrate on startups, you're from the beginning in a risky business, because we all know that these startups usually don't earn money at the beginning, and so that the lending business to those companies is as such risky, and half of their loan portfolio was loans to venture capital and private equity funds in that sector. So from the beginning, it was quite risky to start with that business. And when we look upon the liability side, or the deposit funding, what we could see here is that there were about 30% early stage technology, and then 20% technology, and then 8% early stage life science and healthcare. So if we see that from that, we analyze the business model, we can right from the start say, okay, this is it's a niche bank, but it is they are acting in a business area which is volatile, let's say volatile and risky. But my question then goes more to Greg, because Greg, you were referring quite a lot on held to maturity and available for sale securities, and we usually say in accounting, and I'm an accountant. In accounting, we always hear from banks we don't want to have the fair value accounting model or mark-to-market accounting. So entirely, because, and the argumentation usually is, let's focus on credit risk, and we keep credit risk under control usually, or we build a certain kind of an impairment in that, so loan loss reserves. And however, liquidity, now when it comes to liquidity, well, this is a kind of a market risk and we deal with that. Whereas I am of the opinion that full fair value accounting would have helped. However, we do have to say, looking upon the value changes in held to maturity and available for sale securities, it was starting in late 2021, early 2022 to become negative. So these negative values, they were applicant, let's say 1 year before. So what would you say? Would you say that accounting rules should be changed towards full fair value accounting? And we always had that discussion, that might help, because then we would include all the risks, including the liquidity risks. What's your opinion on that?
Okay, I guess taking your comments in order. I mean, I think the element of Silicon Valley Bank's business model that turned out to be risky, and I don't think something that Jonathan would disagree with, was just the concentration in similar clients. It didn't, the assets, the loans that they made to that sector did not turn out risky, and the bank that acquired Silicon Valley from the FDIC is doing very, very well, thank you, in that market. So just dealing with venture capital, it was the concentration, which I guess gets to one aspect of the supervisor is how do you question a bit part of the business model? Are you talking? I think the old answer, which back 100 years or more is my depositors are my borrowers, so why would they run on me? And I know them very well. I mean, I think when it comes to held to maturity, I don't think that there's anything wrong with the accounting. I mean, I think that traditionally we're supposed to accept the fact that banks hold stuff to maturity, and if they do, they're not going to realize that loss. And that's one answer to the question of how come, every bank that had significant mark-to-market losses, wasn't run. We've all been brought up in bank supervision to accept the possibility that your fair value isn't realistic in the sense that you're going to hold something to maturity. So I wouldn't change the rules over that.
Thank you.
Okay. Edgar, on the chat, you received also a question. You can read it and then answer to that. Bart, it's your turn now.
Yeah, thanks, Christos, for giving me the floor. Basically, baffled by the depth and the sophistication of your analysis. So I was really listening to it with red ears, basically. One of the and it touches a little bit upon Jonathan's presentation, is the subject matter of as to whether or not the analysis has been appropriate. In the October 2023 Basel Committee response to the banking crisis, there's a lot of language on we should start thinking of revising LCR and FSR, basically because of the technology and so forth, so forth. I always found that indeed a bit surprising, because we have had also on the European continent quite some banking crisis of depositors running away overnight because they used their electronic banking tools and so forth and so forth. So this is not new, and certainly not something. What I missed in the Basel report, frankly, is more attention to the behavioral aspect of depositors. So the question, as you just said, as Greg just said, but have we always assumed that if a client is both a depositor and a borrower, they will not the deposit will be more sticky than if you would have depositors that are just simply depositing money with a bank and have nothing to lose if they can run away. So in that respect. Now, my question is, would you agree that lessons learned from the cases that you've been analyzing, when we are looking at revising and improving the regulatory framework with respect to liquidity, because I think these problems cannot only be solved with higher capital standards. So basically, particularly the focus also here in Europe is now on how should we start looking at the liquidity management rules, that we should introduce proper analysis on the behavioral aspects of customers. So basically, when is it likely that a customer walks away, and the probabilities in that respect, and to incorporate these aspects basically in the to be revised rules? Question mark.
Can't hear you,
Jonathan.
Jonathan.
You're muted.
Sorry, this is where the rubber hits the road on business model analysis. So Continental is a good example from 1984. They had large institutional depositors from all over the world, but they could have communicated with each other, but they did not have a lot of pre-existing connections with each other. And so, the Japanese banks and the European banks and the lots of American banks that had deposits at Continental, they all basically made separate decisions. Now they responded to a similar signal because there were Reuters news reports and so on. So there were moments for coordination, but they did not all act as one. Whereas at Silicon Valley Bank, it's beyond the fact that they were all from the same industry. They all had like a very small set of venture capital backers that told them. My understanding from public news reports is that they were instructed by their venture capital backers to remove their money from the bank, and so they were essentially acting in a much more coordinated way than just from the fact that they're in the same industry. And similarly, at the two crypto banks I talked about, this coordinating mechanism of the payment system, they can directly observe whether or not the other folks have run because they can't make payments to them anymore. And so that's a very difficult thing to, like, in the abstract write down. These mechanisms through which it goes even beyond concentration to depositors acting in unison. And as I said, you don't want to. There's a line about regulators not instructing banks what their business models can be, but it's possible. I mean, it's probably possible to have a concentrated business model where the depositors are still relatively unconnected to each other. They're competitors, and not coordinated.
So Jonathan will appreciate. I was just over the weekend reading, as one does, an old paper by Charlie Calamaris about the Panic of 1857. And pointing out that runs within the Irish American community had played a factor in some banks because of that coordination effect. Goes way back.
Okay.
Yeah. Okay.
Jonathan, is there anything you want to add now?
No, I think nothing more coherent than what I just said.
Okay. Greg, you can see there have been a lot of questions for you. I don't know whether you want me to read them for you or you can do it. But there is one on which I would like to further develop, yeah? And the question is why the United States have not applied certain rules of the Basel Committee, like on the IRRBB. And what is striking here is the following. From time to time, I read all the communique of the Basel Committee after the meetings, where they unanimously claim that they are all striving towards implementing the post-global financial crisis reform agenda. And still, it looks like the United States is an outlier on this, on several aspects, not only in relation to some other aspects, for example, the trading book fundamental review, it's also the United Kingdom, So, in general, is there any tendency not to follow and this is a very sensitive issue, because there are considerations that eventually the Basel Committee is developing a lot of rules which are not being complied with by major jurisdictions like the United States or the United Kingdom. So just to generalize the discussion, very good point by Jakub.
It's confusing when I look at I think it's been a while, but the last time that Basel Committee did a review of compliance with the interest rate risk standard, the U.S. got a green light because they had that language that I quoted from the OCC. But to me, that all that does is say that examiners can look at this as a standard. So if there's, like we said, 5 components of that rule, then the U.S. is maybe following the first one. They're at least, having examiners look at that ratio, but they're not imposing anything. They're not attaching anything to it. So it's a little slippery how you determine compliance, I guess. I mean, it's ironic. I mean, it started from the U.S. S&L crisis, and a bunch of banking supervision analysts at the Fed came up with the first standard that ultimately became the Basel standard, and it was applied by the thrift regulator, but not by the rest of the U.S. regulatory system.
Okay. Would you like to give some quick responses to the questions raised here?
Greg, let me highlight for you that there's a few questions about why didn't Silicon Valley manage the risk better? Why didn't they hedge? Why did they invest in what they did in?
Hedging, you're not supposed to hedge held to maturity securities is one answer, and another answer is it would have been horribly expensive to hedge that large a portfolio. I mean, a year after or more after the bank failed, the previous CEO of the bank wrote a couple blogs, which, you know, I guess they have to be seen as defensive, but he was not in charge of the bank when it failed. And he made kind of the same argument that when we were running the bank, you know, we were on top of asset liability management risk, and we would not have put so much money into long dated mortgage-backed securities. You can take that for what you will, because, you know, he can say that. But I think his point was that the part of the business model that blew up wasn't the key. It wasn't lending to venture capital funds. It was the decision by the treasurer of the company to gamble on mortgage-backed securities. And what they told investors was that they thought interest rates were going down. So they're just making a big one-way bet.
Okay, Edgar cannot follow us because he's continuing writing on the chat. Yeah.
I can, and I answered the questions in the chat parallel.
Yeah. Anyway, without being an expert at all in accounting, what I can understand from your discussion here, keep in mind, and Bart may correct me, there is a different treatment of deposits in the calculation of the liquidity coverage ratio, correct? And the term deposits, and anybody else, the term deposits are treated differently than the side deposits, for obvious reasons. So this distinction is applicable already in the regulatory framework, at least when it comes to the liquidity coverage ratio. Greg, am I correct?
Yeah, absolutely. So I think if it's corporate deposits, I'm not sure that distinction applies. That only applies to the V.
Interestingly enough, there's a bit or a big distinction between retail deposits, corporate deposits, particularly also for retail deposits. Banks need to analyze the stickiness of the deposit in view of other services given to the client. For instance, if the client has a mortgage with the bank, it's supposed not to walk away too quickly, because he will then lose the grips on the mortgage and for its mortgage rights of the bank. But I do believe that we could take that particular approach within the current framework a little bit further, to refine it better, to also look indeed at depositors joining up in what happened basically with Silicon Valley Bank is telling each other basically, okay, we want to take our money away and so forth. So I think that particular distinction and these behavioral aspects basically should take a step further. That's my idea. Yeah,
I think you've actually gotten to, if you ask a Fed person why they're not that keen on interest rate risk, I've heard the answer about that standard. I've heard the answer that it's too complex to model because the debate over what's the sticky deposit is too difficult to resolve. I've heard that, which is why you need at least a minimum standard. Is my response.
Greg, because before I give you the floor again to answer to some of the questions that you wish, I have two questions. I would have 20, but I have two questions for Jonathan here. The one relates very important issue. It has been addressed also by the International Association of Deposit Insurers with regard to the role of social media. It's a very important issue, and the role that they play in bank runs. If you have seen the new core principles on deposit insurance of the IADI, published last September, they have taken this into consideration. Now, my questions are not on this. My questions are first on the role of uncovered depositors. And the question is, I remember to have seen that there were proposals in the United States, and there have been also in the EU, to increase the level of deposit coverage in the expectation, I don't agree with this, but I have read it. The expectation that this would eventually mitigate the bank runs because insured depositors would not participate into this. But apparently, the level could not be raised to a point that, for example, the deposits of corporates could be covered. Yeah, and this would not be acceptable, not only in moral hazard terms, but also in terms of efficiency for the banking sector. Yeah, the contributions that would have been paid would be huge. This is my first question. And the second on the business models in your last page. Do you think that we are at a stage where the supervisory authorities should intervene into the business model of banks, indicating that this one is a good one or not? Yeah.
Right.
I mean, from a corporate law perspective, this would heavily intervene into the business judgment rule and any kind of similar considerations. So I'm very cautious about this, but I would like to hear your perspectives.
So there are these proposals floating out there. They're partly about addressing deposit runs, but they're also about there's a concern that the largest banks are de facto 100% insured because they're systemically important, and smaller banks don't benefit from that, and that they've been losing depositors to the larger banks. And so the proposal has been to increase the deposit insurance limit, basically to level the playing field. And obviously, they're beyond the usual insurance and moral hazard issues. The first best solution would be to address the systemic importance rather than just essentially extend the safety net to everybody. But even then, I think when you really look at the math of corporate depositors, in the U.S. right now, the insurance limit is $250,000. If you run a corporate payroll account and you do the math on this, you have to have even like a $10 million limit. There are large corporations that are still way, way above that. One of my favorite facts about Washington Mutual in 2008 when it failed was that, I think, if I recall correctly, it was something like 2/3 of the withdrawals came from accounts with more than $250 million dollars of deposits. So the largest accounts are just way, way, way above these limits. On the second question, business model stuff, I mean, you're absolutely right. We can't do that, and it crosses a pretty thick red line. And so, I've been challenged on this by colleagues in the banking industry, and my response to them is yes, but do you want supervisors to examine your bank's call reports and data without thinking about your business model? And the answer is no. We want them to understand that we have a very safe business model and interpret our balance sheet data in that respect. So if you have a large custody business that results in uninsured deposits, we want supervisors to understand that that's a safe thing. And likewise for any other business model. So that's the easy way to implement it. The harder way is to identify cases like this where you think there's an aspect of a business model that really creates extra danger. Implementing that would be a great challenge. But if I'm correct, and these niche business models are going to become more and more common, is something I really hope we can figure out an approach to.
Thank you very much.
And I agree with that.
Okay. Heinrich, if I may, I see your last question on the CBDCs. I have very recently published a paper, nothing to write home about, but still valuable in terms of information on the proposal for a regulation on the deposit, on the digital euro. It's on the website of the EBI and was published last week. I make reference there in chapter D, where I speak this aspect, on the point raised by a very respectable colleague, some years ago, Hoffman, Christian Hoffman, who raised this issue and said that this could have been a way to get out of runs. But I cannot expect that any regulator, and definitely not in the European Union, would accept a retail CBDC without a holding limit, because it could have a devastating impact on the intermediation function of banks. But anyway, this was a personal view.
I think Heinrich's question is a great one. Whether it's from a CBDC or from some other method, people are actively exploring ways to create something that approaches the safest possible deposit that you can offer people. And I think we have to come up with methods to address it that go beyond
Okay.
just prescribing it. Thank you. I got the last
Let's not
word.
go into this because it's a question, it's a discussion in itself, yeah? Let me give you the floor for the last time. Greg, any answer to the questions, any concluding remarks? We are coming very close to the end.
Not really, but thank you for having me. I enjoyed the conversation. It's been fun catching up with Jonathan too.
Yes, I appreciate the opportunity to meet with you all. Thank you.
Thank you both very much. Thanks to my colleagues for their questions. Thanks so much for the active participation here in the chat. I think we could stay for another 2 hours to discuss each and every point, but that was not the intention here. Apologies again on behalf of Rolf, who could not join. I think he could have also introduced a dimension of how all this spilled over in Switzerland and whether there is a recurrent link, between the Credit Suisse episode, and the situation in the US, even though there was no interconnectedness in terms of balance sheet interconnectedness, but still in terms of the information channels, but I hope we'll have the opportunity to have you again with us and discuss on this or different issues. Thank you very much. Thanks very much to my colleagues, very much to the audience. At the peak, we're 79 people, plus ourselves, another 8. So this makes, in my view, a very successful event.
So,
good evening to everybody, and have a nice day there in the United States, because here it's getting
time for a coffee. All right.
Okay. Thank you very much all, and hope to see you again in one of our events. Good night.
Thank you.
All.
Thank you, Christos.
Have a nice day.
See you.
Bye.
Bye.
Thanks. Inke, can you stay for a moment?
Yes, of course.